G'day everyone, my name's Chris Cullen. I'm the founder, financial planner and mortgage broker at Master Your Money Now. And I'm so excited to go through this presentation called How Millennials Can Buy Their First Home in the Next 12 Months, even through COVID. We know how hard it is for first home buyers to buy their first home and get their foot into the market pre-COVID, and now COVID has made things even more difficult. But there are still plenty of opportunities there for those who work smarter and harder to get into the property market, where you can save thousands of dollars in tax, potentially tens of thousands of dollars in other fees as well. So what are we going to cover? We're going to talk about the 3 steps to a financial plan or any other successful plan. It's really important that we get this structure correct first and foremost. And then we're going to talk about what millennials are doing and not doing to purchase their first home within the next 12 months. And then we're going to talk about your next move, because it's great. One thing to have all this information, it's quite another to actually implement this information and get it happening for you. So, because the information is the easy part, it's getting it into place is the most important part. So we'll talk about that at this presentation as well. Take notes. This presentation will probably take about 45 minutes, so make sure you take plenty of notes. Stop and start this video. If the part that doesn't make sense, go back, listen to it again, do all those kind of things. And look, we do have a lot of content to cover in this presentation, so if you're feeling overwhelmed or confused, that's completely okay. You know, a lot of this stuff you're not going to find anywhere else. It certainly wasn't taught in schools or taught in university. This is going to be, a lot of the things I'm going to be talking about could be very foreign concepts. So if you do get confused or lost or overwhelmed, that's okay. Just stop, take a breather, come back and start the video again, go back over. It's going to take you a couple of goes for you to understand all this information. That's totally okay. So disclaimer, the information I've got here is what we call general information. What that means, it is like quite literally information. It's not personalized to your situation, because I don't know you yet. Hopefully that changes in the future, but I don't know your specific circumstances. So don't implement this information until you get confirmation, until you speak to a financial advisor about your specific set of circumstances. Okay? But a little bit about me. Why should you listen to me? I've been in financial planning now for 9 years now. I've been an advisor for 4.5, 5 years now. I've been doing that for a long time now. About 2.5 years ago, I realised there was an issue with how financial advice was being delivered. It was generally financial advice was being delivered to either the ultra old or the ultra rich. It was, when we had a client that came in at 55 years old, it was considered a very young client, which is quite a bizarre thing to think about. So it was an issue because there was all these millennials, people my age, that needed advice. And I knew that if you get those foundations right in your 20s and 30s, the need for financial advice is very different in your 50s and 60s. I can still remember, before I started my own practice, Master Your Money Now, 2.5 years ago, I remember I was working in a bank, and I remember a couple of clients, one in particular, where they were 55 years old, tradie, back was stuffed, wanted to retire, had to retire, but had 20 grand in super, no insurance, no backup, nothing. And he's kind of like, well, I have to retire, what can I do? The answer is, there's nothing you can do, it's too late. But that's why, I wanted to set up something that focused on millennials, particularly everyday millennials. I specialise in nurses and teachers. My wife's a teacher. My wife's a nurse and my parents are teachers. And that's what I wanted to set up. So that's why I set up Master Your Money Now. I want to be a comprehensive one-stop solution for millennials. We're based in Geelong, but we've got clients all across Australia, and we regularly talk to clients via Zoom, and everyone's become an expert at Zoom because of COVID, to be able to look after clients that way. So we've got about 60, 70 ongoing clients, which is fantastic. And the thing I'm most proud of is the average age of our members is 29. Which is very, very unique in the market. So so I guess I say all that just to give you an understanding. I understand where you are at. As a millennial myself and someone who looks after the finances of millennials, day in, day out. I understand wherever you're at, I understand it, and we can help you. If you're looking to buy your first home in the next 12 months, we can definitely help you as in ways that we'll discuss in this presentation today. So if you want more information, I'm on across social media, Instagram, Facebook, LinkedIn, YouTube. Not on TikTok yet, I'm not quite on TikTok, but there's plenty of information. You want to find out more about myself and us. So you want to buy your first home. That's very exciting. I remember when I bought my first home, I signed the contracts on my 25th birthday. It's an incredibly stressful time, but it's a time that's a lot of fun, and there's a lot of enjoyment and satisfaction once you get the keys to your first home. So I know you, and I'm guessing because you're watching this, you're wanting to buy your first home. But there's this little thing called COVID, and which has certainly stuffed up some things. And a lot of people are asking, is now a good time to get into the property market? There's a lot of words out there that the property market's going to collapse, and due to COVID, and all these doom and gloom kind of scenarios, which of course that's what the media does. They like to sell fear because fear is how they make more money. So let's talk about that. Let's talk about that for a moment. I think it's really important this COVID time. Is now a good time to buy property? And I just want to start off by saying, there's this talk that property always goes up in value. And particularly if you're living in Melbourne or Sydney or Victoria, New South Wales, you've definitely seen that over the last 10 years. What we've got on the screen here, I've just pulled this off realestate.com.au, which if you're buying your first home is the best website to look for that sort of information. But it's, when you look at Melbourne and Sydney, this is how the property prices have doubled in the last 10 years, as evidenced by this graph here. So property goes up in value? No, it doesn't. And this is one I want to pull out for Perth as well. Exact same time frame. This is showing the values of property over the last 10 years. And Perth property in particular has gone nowhere in 10 years' time. So as you can see there, in 2011, it was just under 750,000. In 2019, it's still just under $750,000. So property doesn't always go up in value, particularly if you're in mining towns or far north Queensland. It has dropped dramatically. So let's just put this myth to bed that property doesn't always go up in value. Some properties will, a lot of properties will. We'll talk about that in a moment, but other properties doesn't guarantee to go up in value. So I want to look at some lessons because there was a bit of a property crash back in 2018, especially around Victoria in the COVID areas, before COVID. And I just wanted to just show you this comparison. So this is a suburb called Toorak. If you're not from Melbourne, Toorak is like the top end of town, like the ultra rich, ultra wealthy kind of thing. As you can see here, the average property value was just a smidge over $4 million to get into Toorak. So it's like the most expensive suburb in Melbourne, if not Australia as a whole. But if you go back 2 years there until about 2017, you might be able to see on the screen there, the property market dropped about 15-20%, which means it went from about just over $5 million to just above $4 million. It was a pretty substantial drop. That is a pretty considerable drop in the market back in 2018 when there was a correction. But let's just I just want to show you another survey called Mickleham, and that is in the western suburbs. It's one of the most popular suburbs for first home buyers in the greater Melbourne area. And you can see here that property market, especially in 2017, 2018, 2019, it didn't make much money, but didn't go backwards any money either. It's generally held up in value. And as we go into 2020, the initial analysis suggests it's going to continue to hold up in value. So what do we learn from this? And I think one of the key things when it comes to looking at property is that there is a time when property goes from a need to a want. It's really important to understand that distinction. You see, when you're looking at properties, the $1 million price properties, yeah, everyone wants to live in those properties, but the key word there is wants. And if things do go pear-shaped, like COVID has done with that, and people are feeling the pinch, all of a sudden that $1 million, $2 million, $3 million property becomes a want. It's not a need. You don't need to live in those sort of properties. And therefore people are going to sell, get what they can, and downsize from, say, $1 million property or $500,000 property or $2 million property down to a $750,000 property, whatever it might be. It's the top end of town that suffered in 2018, and I think if there is any property correction, it will be that top end of town that will again suffer in 2020, 2021, whatever it might be. But the everyday properties that everyday people like teachers and nurses can afford, they remained fairly same. I'm not going to guarantee they'll continue to go up, but they retained their value historically. And what I'm hearing as well as we're recording this, it's October 2020, where Melbourne's just getting out of COVID, still in restrictions, but building. Regional Victoria has lifted restrictions a little bit. But the one thing I'm hearing from my clients, a few of the podcasts, like My Millennial Money, She's on the Money, from buyers, advocates, real estate agents, loan market, people that lend money, the banks themselves, all of them are unanimous as saying that in Melbourne, in Victoria, where we're worst hit by COVID in Australia, that demand for first home buyers or people buying their first home has never been higher. And everyone is saying there is just not enough properties for sale for first home buyers. So what does that says to me? That there is still a big demand for those first home properties, and that demand I think is going to continue. And so when we're looking at properties, if you're looking to buy a property in a first home, it's got to be in an area which effectively that you can afford as an everyday millennial, as a teacher and nurse watching this, or tradie, or whatever you might be. Something that everyday people can afford. So that location and price becomes even more crucial. So I think just buying any property is not going to cut it anymore. It might have cut it 5 years ago, but now I think we've got to put some real thought in regards to where you're buying, how much, and what that looks like. So that's not what we do. We don't select properties on your behalf. It's not one of the services we offer. You may want to consider a buyer's advocate who can work on your behalf. If you're looking for recommendations, just send me a message. I can point you in the right direction for a couple of people I know. But the main thing that I want to get out of this, the big question is now a good time to buy? Even with COVID, I would strongly suggest yes, that is still the case. Because again, that demand for property, people still need to live in a house somewhere. And I don't see that changing. There's talk of driverless cars. There's not talk of us not needing a house in the future. So I think that need will still be there, and especially as interest rates are low, and I can't see them going up anytime soon, certainly substantially, then I still maintain that now is a good time to buy your first home. Okay. So enough about me and the market. Let's talk about how we can help you. So there's 3 steps to a financial plan, to a successful financial plan. It's firstly figuring out where are you now? What are your incomes? What are your expenses? Where you're located? Are you happy in your current role? Are you happy with life in general? Really important to really understand where you are now. And a lot of people sadly just don't know where they are now. They don't know what's coming in, what's coming out. They just don't know. So that is something I'd be looking at first and foremost. Then where do you want to be? The reason that people struggle to save, in my mind, a lot is because they don't know what they're saving for. What are you saving for? Where do you want to buy? Why do you want to buy your first home? Where? What sort of lifestyle you want to have? Long term, how long do you want to work for? When do you want to retire? All these things, are really important to get clear, because, no point in creating a plan if you don't know where you're going. That doesn't really work. So where you are now, where you want to be, and how you're going to get from point A to point B, I think is really important as well. So that's what we work through. So where are you now? Let's just talk about that, because I generally find that millennials generally earn a good income. And what do I find a good income? I would always say that if you're a millennial right now, if you don't have a plan to earn 100 grand in the next 5 years per annum, in the next 5 years, then you're probably on the wrong path. And I'd probably suggest that most millennials are heading in that direction, especially, teachers, nurses, will earn 100 grand. Nurses, 100 grand in 5 years, pretty achievable, especially if you're doing overtime and things like that. Teachers might be a little longer because you might have to get a position of leadership on top of that. But tradies, if you've had some sort of further education, 100 grand in 5 years, I would say is fairly achievable. So I generally find that income's not the issue. Most millennials are, if they don't have an income, a good income, they're building their income over the long term. And as a result, I think most people are surprised as to how much they can borrow based on their income. I think most people underestimate how much they can borrow. So if you're on a good income, particularly on a wage, a bit different if you're self-employed, but if you're on a good income and wage there, it's pretty consistent, I think you'll be surprised as to how much you could borrow. In terms of budget though, I think that's where some of the problems are. And obviously millennials like to take a lot of holidays, which can be very expensive. It's been amazing in COVID times that how many people have come to me and said, I've now got 20, 30 grand because I set aside for a holiday that I don't need anymore. What can we do with that? The answer is often buy your first home. So we can talk about that. So the expenditure side of things is definitely something we need to look at. Help and HECS debts is definitely something that will need managing as well. So just something to be mindful of there. Most are renting or living out of home. If you're living out of home, well done. You're going to be saving a fortune. That's going to get you ahead. And then when it comes to saving, most millennials have usually got some sort of savings. Might be 5, 10, 20 grand. I sometimes see millennials with like a lot of car loans, personal debts and things like that. I'd say that's probably rare. And look, if that is you, no worries, we've worked through those situations before. Just might be a little bit longer before you can buy your first home because we want to pay off that debt first before we start looking at saving for your first home. So often they get maybe $5, $10, $20,000 of savings, but getting beyond that point is the struggle. And again, I think that comes back to not having a clearly defined goal and objectives and also ways that you can save better. So questions you should be asking yourself as to where you want to be. What sort of house do you want? Where do you want to live? And the important thing to note here, you're only going to live in this property for 12 months, for reasons I'll let you know later. Do you want to buy or build? Very different challenges if you want to buy or build, and there's definitely advantages and disadvantages to both there. And do you want to live with yourself or with others? And then how are you going to get there? Firstly, and this is generally the process. Firstly, save for deposit. We'll talk about ways that we can do that. Get the grants, because there's a fair few grants out there for you, those who want their first home. Find the home you want, apply for the loan, and move in. That is the very 5-second roadmap in regards to how you can buy your first home. But the big mistake that I find that millennials are making when saving for their first home, there is one big mistake, and I've seen this time and time again, and I just want to get that out here because it is costing you thousands of dollars extra. And that is that you can use your super to save for your first home. Now that's the mistake, is plenty of people are not doing that. They're not aware of this strategy. They're not talking about it. It's not being taught in schools, but you can use your super to save for your first home and save quite a considerable amount of tax in the process. So the way it works is that when you put money into your super account, it's taxed at 15%, okay? So taxed at 15% on the way in and then taxed again on the way out at your marginal tax bracket less 30%. So if you put $1,000 into your super and you're earning 80 grand a year, you're going to be left with $805 for your first home. And you ask me, well, wow, why would I do that? That doesn't really make sense. Let's look at a bit bigger picture, explain what I mean. So let's say you needed to save 15 grand, an extra 15 grand for your deposits. So on the left-hand side, you kind of got to be this graph from left up and then go to your right. So start at $15,000. Now that's $15,000 after tax. So yeah, that's what you've got to save. And if you're on a marginal tax bracket of 34.5% before tax, that's $22,900 that you have to save for your first home. Okay, that's your pre-tax income that you'll need to save $15,000. However, if you directed that money into your super, then you only pay 19.5% in tax, and you would have $18,435 for your first home, a tax saving of $3,435, which is pretty significant. So the way this system works is, so your employer is putting 9.5% of your salary into superannuation, and you cannot use that for your first home. However, if you were to make additional contributions to your super, you can put up to $30,000 into your super over your lifetime for your first home. There is more limits associated with that, but $30,000 over the lifetime, and withdraw those funds again and save $4,500 in tax. And if you're part of a couple, you can both do that. So save $30,000 each and save $9,000 in tax. This is all about working smarter, not harder. You have not worked an extra hour longer. You have not done any extra work. You already work hard, especially if you're a teacher and nurse watching this. You already work hard for your money. This is not about working harder. It's about working smarter. So yeah, definitely something worth looking at. Now this scheme does have a lot of ins and outs and a lot of fine print as well. So make sure you're getting advice on this. But yeah, definitely something worth looking at. If you're working full time at the moment, definitely like to have a chat more about your options here. Because this does lead into a bigger conversation. You know, we're talking about your superannuation, using your super for your first home. Most people don't understand where their super is and how it's invested. Even those who do have one super account, which is certainly a good start, they don't know what's inside their super, how's it invested, and so forth. So I always refer to superannuation like a flower pot, okay? Look, and I'm no green thumb. I'm not a gardener. That's what my wife does. She's a gardener in our relationship. But I do know that it doesn't matter what the color of your flower pot is. What matters is what's inside your flower pot. That's what makes a huge difference. And the same thing applies to your super as well. I would suggest that, you know, whether you're with an industry fund or a retail fund or whatever fund it might be, on the whole, it doesn't make that much of a difference, because that's kind of the color of your flower pot. You know, it doesn't make a huge difference who you're with. What matters the most is how those funds, is what's inside your flower pot or what's inside your super account. Because you can have the best super account in the world, you can have the best rating, lowest fees, and all this kind of stuff. But if you've got that invested 100% in cash, you're stuffed. You're stuffed for your retirement if you've got your super 100% in cash. So I think this discussion about, you know, this industry funds are better than retail funds or whatever it might be, I think that's kind of redundant now. 10 years ago, very different story, because there's a huge difference between your options. But now I suggest that they're all fairly similar. Some exceptions, absolutely, and again, get advice on that and about your options, but I suggest there's a lot of similarities now. And what matters is how you are invested. You know, are you in shares, property, cash, term deposit? Because some tweaks there can literally add significant amount of funds. I'm talking hundreds of thousands of dollars. If you're a 20 to 30-year-old, can make a huge difference there. I was also making additional contributions to super. I was talking about the power of 30, because if you put in $30 a week into a super fund over 30 years in a high growth fund earning 10% a year, I'd like to get 30, but earning 10% a year, that's going to be an extra $300,000 you'll have for your retirement. Okay? And also your plan B as well, your personal insurance cover. That's such an important part of this superannuation conversation. And there could be some insurance in your super accounts. I'd probably suggest it's not going to be enough for you, especially if you're a nurse. I can always guarantee it's not going to be enough for you. So look at some options there. And also, when we're talking about, if you are seeking financial advice and you do want to work with me in the future, look, advice is not cheap. It's a significant investment. There's significant benefits as well. But advice fees can be partially, if not fully paid from your super account. Okay? Most people don't realize that, but your advice can be partially or fully paid from your super account, subject to terms and conditions. So something to be mindful of there. If you want to work with a financial planner and you're not sure how to fund it, you could use your super as an option. So again, we can have that discussion soon. All right, get the grants. I think these grants are really, really important. If you are looking to build in particular, now grants do vary from state to state, so I've got Victoria as an example. So first homeowners grant, buy or build a new home valued up to $750,000. If you're in a regional area, it's an extra $20,000. And if you're a metropolitan area, it'll be $10,000. That's if you build. If you buy, then there's going to be stamp duty concessions, no stamp payable up to $600,000 property purchase in Victoria. Again, this varies wildly from state to state, so make sure you check with your state and about your options there, and something we can talk about as well. So the question I get asked a lot is, how much do I need to pay as a deposit? How much of a deposit do I need to save up? First and foremost, the thing I'd say is that you don't need, a lot of talk is, oh, can't I just use my parents' equity? Can't my parents go guarantors? Is that an option? Look, it is an option, but I wouldn't recommend it. Firstly, that area has got significantly tighter as a result of the Royal Commission. There's a few horror stories released of that, and as a result, it is getting a lot harder to get that family guarantor. But secondly, there's also the non-financial side of it. And I've seen plenty of family conflict where millennials buy their first home, then they want to go on a holiday in 12 months, and the parents are like, hang on a second, you still owe us money, we still own a part of your property, you shouldn't be going on holidays. That's a conversation I've had a lot. That's emotional baggage or guilt, whatever you want to call it, associated with owning your first home. So I would suggest that try and keep the parents out of it, and just focus on buying this property on your own 2 feet. So how much deposit do you need? The absolute minimum deposit you will need is 5%, but you'll have to pay what's known as lender's mortgage insurance. And lender's mortgage insurance, what that is that protects the bank. It doesn't protect you in the event that you are unable to meet your repayments. So just be mindful of that. Effectively, it's another tax or a fee that you've got to pay, and it can be quite significant. As you can see in this example, it's $13,984. Quite a lot of money. But if you have a 20% deposit, you don't have to pay lender's mortgage insurance. Okay, so something to keep in mind as well. But 2 things I want to point out. First and foremost, one, that there are special deals based on your occupation where lender's mortgage insurance can be waived if you have a 10 or 15% deposit, okay? So teachers and nurses, for example, I know there's a couple of banks where you only need the 15% deposit. And in some other occupations, particularly doctors and lawyers, it's only 10%. So check with your occupation. And again, this varies from lender to lender as well. It's not that every single lender, for example, allows a 15% deposit for nurses. It's only 1 or 2 lenders out of the 60, 70 lenders that are out there that will give you that option. So make sure you're speaking to a mortgage broker to see what is the best option for you, okay? So yeah, occupation's a big one. But the other thing that's worth noting as well is that Scott Morrison, in his election in 2019, said that for first home buyers, they don't need to pay lender's mortgage insurance. And so there is a scheme, what's known as the First Home Loan Deposit Scheme, that for 10,000 first home buyers, they don't need to pay lender's mortgage insurance. So that's a saving potentially, $13,000, $14,000. It's pretty significant. But the big catch on this, and there's a few catches, but the big one is that the grants available per year is only 10,000. And we take into account there was 106,000 first home buyers in 2018, that is a problem. It's definitely a get your elbows out, get in as quick as you can. So there was 10,000 spots released on the 1st of January, and most of those were filled by about the 15th of January. There was another 10,000 spots released in July as a result of COVID, and those were filled by about the end of August, so it was a little bit longer. There's another 10,000 spots that are due to be released in July 2021. It wouldn't surprise me if there's another 10,000 spots released in January 2021 as a result of COVID as well. So watch that space there. But I guess what I'm saying is, there is definitely opportunities there for you to save tens of thousands in lenders' mortgage insurance, but you've got to be prepared. You've got to have all your ducks lined up to ensure that you're able to take advantage of that opportunity. So, okay. All right, so common questions that are asked by millennials. Does a credit card actually help my house deposit? I get this question a lot. For some lenders, yes. For most, no. And I'd probably argue that for most lenders, I wouldn't personally worry about it. Some people say, oh, you need a credit history, but yeah, you don't really need. If you've never had debt before, that's okay. It's generally not going to be an issue there. Should I get an offset or redraw facility? Should I go fixed or variable? Which bank should I go with? Whatever bank you go with, don't go with the bank that you banked with as a child, because there's plenty of variations between the lenders in regards to rates, in regards to how much you can borrow, processing times. There's plenty of things that you need to consider and when going for a bank. So make sure you go through a mortgage broker that can go through all of your options. Does help HEX debt impact my application? Yes, it does. Let's talk about how that works and what that looks like. And how do I do all the paperwork? I think that's a really important thing. You don't need to do all this paperwork yourself. You can get someone in to help you. Cautions and costly mistakes. The biggest one is they just go for the cheaper rates. And I think the first rule of mortgage broking that we're talking about is the rate is probably about the fourth or fifth thing that we look at. The first thing we look at is turnaround time. There are some lenders that will give you an answer within, say, 24, 48 hours regarding your loan. There are some where it can take literally 4 months before you get a response. I'm not kidding. It can take up to 4 months. COVID times in particular are terrible. I submitted a loan in mid-June and it's now early October and we still haven't received a response. Suffice to say, we've gone for a different bank, but I've just kept it open just to see how long this would last for. And yeah, we still haven't had a response yet. So if you're looking to buy your first home and you've got 2 weeks to arrange finance, although I'd always recommend a pre-approval first, that time thing becomes crucial to get everything done. It's a very stressful time. You don't want to be held up by a slow bank. So it's more than just the cheap rate. And also how much you can borrow does vary a lot from lender to lender. So there's plenty of things you need to consider. And that's why talking to a mortgage broker who can look at the whole suite of options for you and gets the best option that's tailored to your situation makes a huge difference. So don't go to the bank you've had your kids, because you had a Dolomite account or something there. There's broader options there. When it comes to your everyday banking, there's not a huge amount of difference, but when it comes to a mortgage, huge amount of difference. It pays to shop around, and also to shop around. If you do have a mortgage at the moment, look for new deals. I'd say every 2 to 3 years. There is no loyalty in banking. There's a lot of incentives for you to refinance your home in the future. So every 2 to 3 years, I'd probably suggest you should be looking at alternatives for your mortgage. So something to be mindful of there. Speak to the wrong people. They don't use their super to save for their first home, as we talked about. They don't get advice. They try and do it all yourselves. That doesn't work. Don't try and do all this yourself. let's think about this from a practical perspective, and I know I've got a lot of teachers who are going to be watching this video. Should you DIY your education or your health? You can use either example, let's just say that, if I said, forget about teachers, forget about nurses and doctors, they don't know anything. You should just, do all your education yourself. You can learn it all online. You can just do your health, all that stuff yourself. You can do that online as well. I think if I said that seriously, I'd probably end up in jail, because that is such a ridiculous, reckless comment to make. And particularly from the health side of things, that could potentially cost someone their life. So this DIY of your health and education, no one would even really think about doing that. I know a lot of people do homeschooling, but I would probably suggest that teachers are going to do a better job in 99% of cases than if you homeschooled yourself. That's just my personal view. Maybe that's wrong, I don't know. But definitely from a health perspective, you do not want to be DIYing your health. So, but yet there's this feeling that you've got to DIY your finances, which for me doesn't make sense, because we engage experts with our education, we engage experts with our health, but yet we don't engage experts with your finances. And for me, that makes sense. And I know what that leads to. That leads to people feeling more confused, more anxious, more concerned, lost, analysis paralysis, and I think above all else, they feel alone and there's no one they can turn to. And that for me is wrong. That's something that we can work through. Because at the end of the day, like people say, you just need more information. No, that's not true. If information is all that we need, we'd all be billionaires with six-pack abs. I love this saying because it's so true. We've got all the information. You've got all the information is out there for you to buy your first home to get fit. It's all out there. It's all on Google. But yet we've got, health-wise, we've arguably never been unhealthier. Obesity levels are going through the roof. And, we're certainly not all billionaires. That's certainly not true. So if you're thinking that information is all you need, no, you don't. That's probably about 10%. It's applying that information in a timely manner. That's what makes a difference. And information that is tailored to your situation is what's really, really important. So here, you do have a choice. You've got the DIY option where you can research the options yourself, use Google, contact your super provider, deal with payroll with all your paperwork, speak to a bank, and look, good luck to you with that if you do that. Get your insurances yourself, talk to multiple people, and doing this on your school holidays or on a break or whatever it might be. You've got all that is an option. Can you DIY this process? Yes, you can. Would I recommend it? Probably not. And that's where I probably suggest this other path is what I call the GIDFY option, which is the get it done for you option. Where you have that one trusted source of contact that specialise in millennials. We can meet after school, on your holidays, after work, whatever it might be, depends on your occupation. We do the paperwork for you. That's, I think that's worth its weight in gold in itself. We'll complete the paperwork, we go through it with you, but then it's just go sign here, sign here, sign here. Our job is to make that paperwork side of things easy as possible. And you're buying your first home, there's a hell of a lot of paperwork to be mindful of. So we do the research for you. We speak on your behalf. So if your super funds or bank or whatever it might be is not doing what it should be doing, we can speak to you on your behalf so you don't have to. And that just reduces the stress and the hassle in your life. It's all about delegation. This whole concept that you've got to do everything yourself, that's impossible. You can't do everything yourself. And I think it's a skill that you're going to need both now and in the future in your work, in your family life. As this world is getting busier and busier, you need to delegate. Delegation is such an important skill. So you can delegate the work with your finances so you can have more time enjoying life and move into your home in the next 12 months. Because imagine you are getting the keys to your first home 12 months from now. How would that feel? What would be next for you? Because we're just talking about home number one here. I mean, there's Plenty of things that we look at in the future as well, buying more properties, more investments, so you can retire, potentially retire at 50. That's something I'll talk about in another webinar which I do called the Rags to Riches Roadmap, how you can potentially retire earlier. A whole different discussion point there. But yeah, imagine how that's feel, that you've bought your first home in a tax-effective manner, saving $4.5 grand in tax. You didn't pay lender's mortgage insurance. You got a good rate with a fast bank. You got your super sorted, you got your plan B sorted, and you're on the way to building wealth so that you can retire. When it does come to retirement, you've got more that you can enjoy. But most importantly, you can enjoy life now as well, because it's balancing both. It's making sure you can enjoy life now and go on those holidays once COVID's over, enjoy eating out, doing all those kind of things, but also knowing that you've got a plan, a structure in place where wealth is building in the background. And once you do come to retire, that you've got something to show for your hard works and effort. That is very achievable. It just doesn't happen by accident. You need a good plan in place, good structures in place, and the right advice to ensure you get to that point. So what I'd like you to do, thank you very much for your time and going through this, this video. I want to invite you to a 30-minute money strategy session. It's completely complimentary. You have a chat either myself or one of the team over the phone, answer any questions and concerns you might have after watching this video, because I'm sure you've had plenty of questions on this. And just understand, you know, what you want. That's really important. It's not about me, it's about you. What do you want to get out of this process? What do you want to achieve in this life? What do you want? And just see if we're a good fit to potentially work together, because we don't work with anyone. We don't work with people that are not coachable. And you know, look, teachers and nurses, because effectively they are coaches. One's an education coach, one's the health coach. You know, I generally find teachers and nurses to be quite coachable. We don't work with people that once off set and forget. You know, once off advice doesn't work. You know, it needs to be ongoing. You have ongoing help with your education. You've got ongoing help with your health. You need ongoing help with your finances. That's what we offer. Have no accountability and do not appreciate the value of advice. And I'd suggest, particularly if you're watching this and you are a teacher or a nurse, that you do appreciate the value of advice, because you give advice on a daily basis. So yeah, something to be mindful of there. Who we do work with, we work with everyday people. You know, we don't work with, you know, these people earning $500 million a year. That's not what we do. If you are in that situation, love to have a chat, but you know, our niche is everyday people, teachers, nurses, tradies. That's who we work with. They're coachable and open to learning. Acknowledge they don't know everything. I don't know everything, but it's amazing how many people think they do know everything. And clearly, often you find they don't, but yeah, acknowledge that, yeah, there are some gaps and you need help. That's totally fine. Are looking for a long-term partnership and want to enjoy the journey together. They're aspirational, you know, want to talk about the next level. This is kind of level 1 or 2, buying your first home. You know, there are plenty of levels after this where you can grow and expand your wealth. Will refer their friends and family. It's really important. And have fun as well, because, you know, life's too short to be miserable and depressed and stuck in home inside with COVID and everything like that. It's too short for that. We want to be fun and live a life that's bigger than themselves. You know, and this is something long-term we talk about. You know, once you build wealth for yourself and wealth for your family, you know, there's a community out there that need it. There's a cause I'm sure that you've got that, you know, how good would it be if you could make a significant difference to that cause? How good would that be? You know, that's a long-term aspiration. That's, you know, advanced thinking. But you know, we've got to live a life that's bigger than ourselves. And again, teachers and nurses, I know, get that because they're doing that on a daily basis. So it's really important. It doesn't matter where you are now. You know, I've worked with people that have got 50, 60 grand in personal debt. I worked with another client that had a loan which had a 46% interest rate. Nothing surprises me anymore. I've seen it, dealt with it all. So it doesn't matter where you are now. And for the record, if you're at 0 right now, that is the best time to start. If you've just graduated from university, just got that first full-time job, you are the perfect person to start, because starting at 0 probably puts you ahead of 30 to 50% of the population. So if you think, oh, I don't have any savings, no, now this is the perfect time to get some savings, perfect time to get in advice. Because again, it doesn't matter where you are now. What matters is where you want to be and whether you're doing to do what it takes to get there. So if you want to have a bit more of a chat, please go to masteryourmoneynow.com.au/get started and book in your complimentary 30-minute session with me or one of my team. We can have a bit more of a chat about your situation. Again, thank you for taking the time to invest in yourself and listen to this presentation. I'm sure I'd love to hear from you in the future. Have a good one.